Boa tarde a todos, tudo bem? Meu nome é Mariana De Biasi, eu sou responsável pela parte de seleção de gestores de fundos para os nossos mandatos internacionais dentro da XP Private. Hoje temos uma conversa aqui muito especial com Howard Marks, cofundador e co-chairman da Oaktree Capital, e Paulo Lehmann, nosso Executive Chairman do Comitê de Alocação Global da XP Private. Vamos ouvir do Howard sobre o novo fundo que a Oaktree está levantando, conversar sobre investimentos em distressed e sobre por que agora é um bom momento para se investir na estratégia. Antes disso, devemos começar com o seguinte disclaimer. Nada que será apresentado hoje constitui uma solicitação de venda ou recomendação de que qualquer produto ou estratégia de investimento da parte da XP Investments US LLC, que é uma corretora americana, membro da SIPC, FINRA e NFA. As informações que serão apresentadas são apenas para fins informativos e não se destinam a fornecer conselhos financeiros, fiscais, jurídicos ou contábeis para você e não devem ser considerados como tal. Não há garantia de que o investimento em qualquer produto ou estratégia aqui discutido será lucrativo ou não incorrerá em perdas. Antes de fazer qualquer investimento, consulte seus consultores financeiros e fiscais para garantir que suas circunstâncias foram devidamente consideradas. Paulo, por favor, é com você.
Muito obrigado. And I'm switched to English. For me, it's a great honor to be able to introduce Mr. Howard Marks. Howard is a reference in the world of investments. Currently, Howard is the director and co-chairman of Oaktree Capital, with roughly assets under management around 120 billion plus, where he sets the core investment philosophy and the big picture for investments and also the main corporate decisions. And like today, I think what's great, Howard always makes himself available to communicate with clients and discuss opportunities like this distress fund. Howard has a distinguished career in finance. I'll highlight just a few, otherwise I will spend like 20 minutes. First, he led the investment part and the distressed debt, high yield and convertible bonds at a very important distressed debt, high yield house, TCW, in the period between mid-80s and mid-90s. He also comes from the big school of Citicorp Investment Management, where he was senior portfolio manager in convertible and high yield securities. So it's a big group of fantastic investors came out of that. And he's also the author of two respected books about investments, actually one of which, it's one of the textbooks for my course in investments at the University of Miami, The Most Important Thing, and the other one, Mastering the Market Cycle. Howard has also time, I don't know where he finds it, but he dedicates also time for the world art. He's a chairman of investment committee at the Met in New York, and also academic endeavors, where he's the emeritus trustee at the UPenn. He was also chairman of the investment board. And he holds a Bachelor's of Science degree with cum laude from Wharton School of the University of Pennsylvania with a major in finance. And I think we spent times while you were at doing your MBA at Chicago. I was doing my PhD in economics at Chicago. So he has, with distinction and honors, a degree, an MBA in accounting and marketing from the Booth School of Business of the University of Chicago. So Howard, very welcome back to XP. And the floor is yours to discuss the Opportunity Fund. Please, Howard.
Thank you, Mariana. Thank you, Paulo, for that kind introduction. So just to add a little bit onto the introduction of Oaktree, back about 15 or 20 years ago, the investment world, which is always inventing new words, invented the new word of credit. And credit refers to debt, which is not government debt. So it's corporate debt. And credit is the word that applies to the things that Oaktree does, most of them. And my involvement in credit, or what's now called credit, began in 1978 when, as Paulo described, I was at Citibank and I was asked to start a portfolio in high yield bonds. That's the bonds of companies which are not investment grade companies. And 1977, 78 was the beginning of the high yield bond world. And I was very fortunate to get involved in 1978 at the very beginning. And the fund we formed at Citibank in 1978, I believe, was the first high-yield bond fund from a mainstream financial institution. In the mid-'80s, as he said, I moved to Trust Company of the West. And there in '88, I was joined by my partner, Bruce Karsh. And Bruce was a lawyer who had the idea of forming a distressed debt fund, a fund that would buy this debt of companies that were bankrupt or likely to go bankrupt or considered likely to go bankrupt. And we did that starting in '88. And again, I believe that was the first distressed debt fund from a mainstream financial institution. And Bruce has been managing those funds ever since. We have managed about 20 funds with about $45 billion of capital. And I believe that in all these areas, our experience is the longest of any money manager. So, I believe that our record in distressed debt goes back 32 years. I believe that is the longest. Hopefully, it's a good record. And I want to tell you about our activities in distressed debt today. So if you turn to the first slide, it talks about our investment approach. The elements are, number one, because of the prevalence of distress, and because distress scares people most of the time, we are able to buy claims on assets at bargain prices. And of course, every great investment begins with a bargain purchase. And our principal approach is to focus on senior debt. Now, the higher you are in the capital structure, the more senior, the higher the likelihood of making money and the lower the likelihood of losing money. The lower you are in the capital structure, your successes are bigger, but so are your failures. And your probability of failing is higher. So by staying high in the capital structure, we have a higher probability of winning, but a likelihood that we will make less than the people who are successful in the successful investments. So we trade off some return for an increase in probability of success and safety. Now, our companies our mantra is good company, bad balance sheet. So our companies are what we call financially distressed. That is, they have too much debt to get through a difficult time in the environment. They're good companies with good products and good management, but too much debt. So you can fix a good company with a bad balance sheet by restructuring the balance sheet. It's a lot easier than fixing a bad company. And we try to avoid investing in bad companies. Our investments are in a variety of areas. They have usually hard asset value, that is saleable assets, dependable cash flows, and a good business franchise, just too much debt. They're domestic or foreign, public or private. We invest in both corporations and assets themselves, and our companies can be special situations or unusual investments. And once we are invested, as you see on the left side, then we move over to the right side, and our where things work, which they usually do, we get one of two outcomes. We're either paid off on our debt, the interest and the principal we're owed, which produces a good return since we bought at a discounted price, or we go into a bankruptcy and a restructuring, and there usually we are active in the bankruptcy. We get to influence our outcomes. We drive a turnaround through board representation, and we have the potential for substantial gains, often by getting an ownership interest in the company at a depressed time in the cycle, and thus at a depressed price. New slide, please. As this slide shows you, we invest in a large number of areas. Starting from the lower left, we invest in private debt. That is debt which is privately issued by companies, not traded in the markets. Liquid credit, that's debt which is traded on the markets, usually bonds or loans. Real estate and real estate related debt, and the debt of real estate companies, which is backed by the hard asset of the real estate. We have a central trading desk which trades all the debt which exists, not just the distressed, but the non-distressed and the real estate debt and the high yield bonds and what we call the performing credit, so that one desk sees everything that's going on. We invest in emerging markets. We have emerging market specialists with a great record. Now that's corporate debt. It's not sovereign debt. We don't think that sovereign debt can be invested in as attractively as corporate debt. And we also sometimes invest in what we call value equities, which is equities which can be bought at a discount from what we think the assets and the cash flows are worth. The next slide shows that we put a very heavy emphasis, as I indicated, on risk avoidance, risk control, downside protection, however you want to describe it. And Oaktree has a simple investment philosophy which governs everything we do with 6 points. And the first point, the most important point, is what we call risk control. Our motto is that if we avoid the losers, the winners take care of themselves. And a long-term record, which shows many successful investments and very few unsuccessful investments, can produce a long record of dependable success. And as you can see from this graph, 73% of what we buy in the funds is debt. The majority of the debt is senior or secured debt. And most of our funds have had, as you can see from this chart, roughly 70 to 80% of their investment is in senior or secured debt, where we have a very high probability of success. 27% is either subordinated debt or equity over all our portfolios over the last 32 years. And investing in good companies with assets and cash flow and at the senior level increases the probability of success. And our record shows that, and I'll demonstrate it to you in a moment. We trade actively. Our funds have low turnover. We are long-term investors, and we do not use leverage. We do not borrow money at the fund level to increase our returns. We never buy assets which exceed our capital. So, as we say, we're not levered. Now, the next slide shows you the result of investing to control risk and hopefully the effect of investing with a high level of skill. So, as you can see on this chart, we started over all of our funds. This is all of our funds combined for the last 32 years. We started with $46 billion of capital. We have achieved outcomes, either gains or losses, of 39 billion, 38.8 billion. Of those losses, almost 90% of those outcomes, almost 90% of them, 34.3 billion, have been gains. The losses have been only 4.5 billion, or just over 10% of the outcomes. And this, of course, is as of June 30th, which takes into account the pandemic and related declines in the value of some positions. So far, as I say, roughly almost 90% of our outcomes have been positive. That's the result of investing senior, investing in good companies, and as I say, hopefully investing with skill. So the 46.3 billion has turned into 80 billion of value, of which 65 billion already has been realized and distributed, and we're still holding 11 billion of assets. And of course, those assets, we hope, are still subject to further gains. Next page. The important thing is that over the 12 years since the global financial crisis occurred, the world has become much more levered. Debt was available in large amounts and inexpensively, low interest rates. That encouraged companies, investors, and funds to increase their leverage. So it was easy and was cheap to borrow money, and a lot of people engaged in extensive borrowing in order to amplify their returns. So as you can see on this chart on the left, in 2002, there was approximately $1.5 trillion of non-investment grade debt outstanding, lower rated global corporate debt. 1.5 trillion in 2002, went up 2.6 times, so that it was 3.8 trillion at the time of the global financial crisis in 2009. It went up another 2.6 times, so that by the time 2019 rolled around, there was $10.1 trillion of non-investment grade debt around the world. That's BBB corporate bonds, leveraged loans, high yield bonds, and direct loans in the mid-market. So a very extensive increase in our potential supply. Now, this is not all things we'll buy, because of the 10 trillion, we only buy the part which declines in value or offers very high rates of return. But obviously, with the non-investment grade market at 260% of what it was 11 years ago, we have a lot of scope for opportunity. By the way, our '08 fund, which we formed, that was the biggest fund in the history of distressed debt investing. We formed that in '08 to invest in the global financial crisis. Now, we formed it in advance of the opportunity. We thought the opportunity was coming, and we formed it in '07 and '08 in order to be able to swing into action when the opportunities came, as they did. That was 11 billion. Today, we're forming a fund which has a target of about 15 billion. We've raised about 12 so far, and we'll raise more, but we will not go much beyond 15. We hope to raise a bit over 15, but not much. So the market is up 160%, and this fund will be up, let's say, roughly 50%. We think that we're raising a moderate amount of money. And as this chart shows you on the right, the leverage of companies has increased over this period of time, and it reached 5.2 times EBITDA or cash flow last year. So levels of debt, there's a large amount of debt, and companies are highly leveraged. Now, the question is, what has happened this year in the pandemic? And of course, roughly 6 months ago, the pandemic arose in February for most of the world. Security prices collapsed, and if you'll put the next slide on, you can see the declines in the stock market and in the high yield bond market, and both declined a great deal. Stock market was down 33%, and the high yield bond market was down about 23% from the end of 2019 to the low, which was reached in late March. And now you can see that the stock market has recovered the entire decline, and so has the high yield bond market. So I tell you this to say that in March, when the markets were very soft, as you can see, we spent roughly $1.2 billion or $1.3 billion to buy distressed debt at very low prices and very high potential returns. Now the markets have snapped back thanks primarily to the rescue efforts of the Federal Reserve Bank, and by definition, the same bargains are not available in the public debt markets. The vast majority of what we have done, and it's been again a couple billion since the beginning of April, has been what we call rescue transactions, which is not buying existing debt in the public markets, but working with companies which, again, have cash flow, have strong assets, have good management, have good products, but have an urgency, have a problem, an emergency, companies that need finance, and putting money directly into those companies. Now, what we've gotten so far is very senior status, so that we are senior to all the other creditors, security in the form of the company's assets in most cases, and very high potential returns. So a combination, we think, of high potential returns with low risk. And of course, today, when the prevailing interest rate in the US and most of the world is zero, we can't expect the returns of the highest performing funds in the past, but we can expect returns that are superior, I believe, to other asset classes. Now, we have managed money in our 32 years in distressed debt through 3 other crises. In 1990-91, most of the prominent LBOs of the 80s went bad, and the high yield bond world was under pressure. Drexel Burnham and Michael Milken, which had pioneered, were closed down and put in jail. And we achieved extremely high. There was a recession and a credit crunch, and as a result, we were able to get great bargains and achieve ultra high returns. The same was true in 2001 and 2. The tech bubble imploded. The telecom companies had overexpanded to build fiber, and many of them were downgraded. And we had the scandal companies at places like Enron, very high returns for the Oaktree funds. And then, of course, we had the global financial crisis of 08, 09. Subprime mortgages melted down, financial institutions bankrupt, recession, credit crunch, very high returns again. Nowadays, with the Fed rescuing and with more people interested in distressed debt, we can't expect to get the same returns as in the best funds in the past, but I think we can still achieve superior returns as shown on the next page. So this shows our track record all the way back to 1988. And as you can see at the left, over the years, the sum of all of our funds have achieved a 21.8% gross return, we call it IRR, and a 15.7% net return. And that gross return of 21.8, you can see, is more than double the return on the S&P, the Barclays U.S. High Yield Bond Index, and triple the Barclays Aggregate Index of all bonds. We break this down into 2 periods because, you know, you can say the world may have changed. So from 88 to 02, we earned a gross return of 22.3, again, double or more the competitive indices. From 03 to 20, our return is lower, 20.7 gross and 13.9 net. But again, the gross return is still more than double all the competitive alternative investing indices. So I can't tell you how many investment opportunities we're going to have in the next year or two. I can't tell you how good they'll be. I can't tell you what the returns will be. I continue to believe that the distressed debt universe will offer superior returns to other things, and that Oaktree will be able to garner them for you and its other clients. So I've covered everything I'd like to. I'm going to stop talking now, Paulo, and I'll let you and your audience ask questions.
Well, thank you very much, Howard. I think very clear, very exciting in terms of looking at this asset class. And I think I'll start exactly from your last point in terms of looking at expected return, and particularly looking at some of the usual benchmarks like S&P and other indices. I think that most investors have become very comfortable with just the risk-reward mean variance space. And have really missed out in other dimensions of the investment decision, which includes liquidity, where in the capital structure you go, in terms of leverage as well. So how would you see, in terms of a world where you have a risk-free rate either 0 or negative, expected returns have declined, to maintain the returns in your portfolio, you have to add a lot of volatility. What is the role of distressed debt, which I think is extremely important, is that I think something that has not been well understood by investor, I think will have to come into the portfolio to be able to maintain that nice sharp ratio with returns and volatility. Of course, how do you see that, Howard?
Our market is largely a non-traded market. So, and as I mentioned, we're not traders, we're long-term investors. Many of the things we buy, especially the rescues, will be private transactions. Now, of course, if they work, they'll be very saleable because there'll always be somebody who wants to buy them. But these are not public securities. So our portfolios are largely illiquid, but that's okay because number one, we don't expect to trade. And number two, the fund is a closed-end fund. People can't withdraw from the fund until we're ready to pay them out. So we don't need liquidity. And we are unlikely to get into a liquidity problem. I think you asked about the role in portfolios, and that's very important. And I think that distressed debt is and has proved to be a great diversifier. Our best funds have been the ones formed at the worst of times. And I think they will continue to serve that purpose. So the point is, if your clients have what I call prosperity-oriented investments, if they have private equity and other leveraged forms of ownership, if those funds do very well, we're not going to get great opportunities to invest. They'll do better, perhaps, than we do. But if those things have a problem, we'll have great opportunities to invest. So historically, distressed debt, I think, has been a great and prudent diversifier for portfolios. Historically, as you can see, high returns. We've had, as I say, 46 billion invested over 32 years. We've never had a fund that lost money, and a good diversifier for good time investments.
Perfect. Mariana, I would like to ask a question.
Sure. Just prior to asking the question, Howard, your screen is black. I would ask you to unlock your phone. I think it will go back to the app and show your picture again.
Well, I'm very sorry. I have to figure out how to do that.
We'll wait.
No worries.
If I put it up, maybe it'll recognize my face. No? Oh, no. I have to. No, I can. Let's see. I can do it. I know I can do it. How? Gosh. I'm very sorry. That's not.
Not a problem.
Cancel.
I think that if you go back to the app that we were
Now
using, you should show video
Sorry,
again.
Everybody.
There you go. Perfect.
Okay. Great.
There you go.
Good. So go ahead with
You're
your question,
back.
please.
Thank you. Obviously, COVID-19 has created great dislocations in valuations, particularly among highly levered and yet financially viable firms. And the shock of having so much debt in this cycle versus the great financial crisis results in a situation where a lot of firms were in precarious positions prior to COVID-19. Do you think that even with the actions of central banks around the world, the opportunity set for investing in distressed is a rich one? How do you feel it compares to previous cycles? And how within each sector do you find investment opportunities?
Well, as you know, in the COVID world of this last 6 months, there have been winners and losers. The winners have basically been companies whose business models are particularly appropriate for the COVID world. And the greatest examples would be Netflix, because a lot of people are sitting home watching videos, and Amazon, because a lot of people are ordering from home. And many tech firms are doing very well, and the tech stocks are up well, maybe close to 100% from the market low, which was achieved in late March, and are very substantially up for the year to date. Maybe, I don't know, 50%. On the other hand, there are a lot of companies that are suffering. Hotels, hospitality, travel, movies, anything that is based on people physically getting together has been doing very poorly. So has retail. Stores have been on a downtrend for years because of the significance of shopping from home online, and the COVID has made that worse. So we have substantial winners and losers. Now it happens that Oaktree Distress does not invest in technology. Technology does not fulfill our need to have tangible, saleable assets. And of course, the developments in the world of technology can radically change from year to year, and it involves more uncertainty and less stability than we invest for. Of course, it has great growth potential, but with significant uncertainty. So the fact that technology is up doesn't diminish our opportunities. The many things which are down adds to our opportunities. But of course, we have to make sure that they are good companies with a good future, not companies that are melting down. So we are making substantial efforts, as always, to distinguish between the two. We've made a lot of very successful investments in the last 4 months. And most of them are in, well, we're investing heavily in energy infrastructure, which we think will have lasting value, and substantially in real estate lenders, where we think we have good collateral as long as we're at the top of the capital structure. So I think that we have gotten a lot of opportunity in the losers, in the companies that have not fared well in COVID. Now, it's very important to remember what I said. Because of the public debt market snapping back, that has diminished our opportunities. You know, in the public debt markets at this point in time, in 02 or in 08 or in 91, there was panic in the public debt markets, and we were able to buy up debt extremely cheaply. That panic doesn't exist today because of the Fed's rescue, and that's why most of our opportunities are in the private debt market and in rescues, and why I'm not talking about returns like we used to talk about in the best of funds. You know, we used to talk about gross annual returns of 25 to 30, or sometimes 30 or more, and in some of our crisis funds, we did achieve returns like that and more. I'm not talking about those today because the Fed's rescue efforts have eliminated the element of panic from the public debt markets.
And along those lines, Howard, I think talking about the Fed's presence, I think on the one hand, it unfroze a market that was dysfunctional in March, April.
Right.
But the question is to what extent that created kind of an adverse selection, because for the sheer fact that the Fed was present, and it created some of the facilities, borrowers that otherwise would have failed or would have been in a distress situation, probably they gain extra time to deal with a crisis. So to what extent that created, like, let's say, an adverse selection in terms of the sample of the companies? I know that you had to go to the private markets and to do really special situations, but to what extent that presence skewed the universe of eligible assets that you would acquire?
Well, Paulo, that's exactly the right question. And I don't know if it skewed the market as much as it did reduce the opportunities. You know, in our 1990 fund, and in our 2001 fund and our 2002 fund, we achieved gross returns before fees ranging from 44 to 58% a year, because there was panic, because the capital markets were closed, and because companies melted down. So, you know, that's the reason I'm not talking about those kinds of returns nowadays. I would be happy to achieve half that. You know, if we could get gross returns of 22 to 29, I'd be ecstatic. If we achieved a third of those returns, which would be, 15 to 20%, I would be happy in today's environment. And, you know, we have to be realistic. You're right. The Fed has kept a lot of companies breathing, which should not be alive today, and under normal circumstances would not be alive today. And we call them zombie companies. These are companies which lose money. These are companies whose debt service, that is paying the principal and the interest on their debt, exceeds their cash flow. So these are companies which are burning money every day, which are losing cash flow, which are experiencing negative cash flow net every day, and yet they're staying in business because the Fed is providing liquidity.
Right.
So, number one, these companies, normally their debt would be available extremely cheaply. And number two, there would be panic in the markets normally. These companies, most of them, the Fed can't keep them alive forever. What we're saying is that the Fed can provide liquidity. It cannot provide solvency. That is, it can't make a bad company into a winner, but it can keep it alive, and it has done. And we believe that many of these companies will get into trouble anyway, and the good companies among the over-levered companies, of course, will be the ones that we invest in. But you're absolutely right to say that the Fed has diminished the opportunities.
Yeah, and I would just kind of to complement that question, I would say also this is a very peculiar health shock. And I think we're still maybe in the second inning of it, and there's still a lot of surprises to come. So would it be fair to say that the universe of eligible companies still has to manifest itself, because we could have a second wave in the fall, and really time, the time decay of some of these cash positions of some of the companies will go against them. So would you agree that perhaps the opportunities have yet to appear with a higher return still in the next 6 to 18 months?
Absolutely. Absolutely. We think there are going to be a lot of defaults, a lot of bankruptcies. Now, defaults and bankruptcies are still running high already.
Mm-hmm.
A big percentage of them is either retail stores or oil producers. Many of these will fall to us in terms of opportunities, and we think there will be many more.
Mariana, I would like to raise a question.
Yeah, Howard, you mentioned in your latest memo, Time for Thinking, the whole situation about the Fed providing liquidity and asking yourself, how long can you hold up? And bringing us back to the previous observation about, well, the Fed may be able to provide liquidity, but not solvency. What do you reckon could be some of the trigger points that would indicate that the Fed will not be able to support markets the way they're currently supporting?
I think the Fed and the Treasury swung into action correctly, very dramatically in late March, and I think that the will to keep, the Treasury has spent over $2 trillion in support payments. That's a deficit. That's money that we're paying out that not taking in. So the deficit for this year was expected to be about 1.3 trillion, which is ridiculous. I mean, when the year was expected to be a year of prosperity, they were projecting a 1.3 trillion deficit, and there shouldn't be deficits in times of prosperity. Fiscally conservative people like me feel that there shouldn't be deficits in times of prosperity, but it was expected to be 1.3 trillion, and now it's projected to be over 4 trillion. And the U.S. National debt has gone up to 27 trillion this year. Similarly, the Fed has increased its balance sheet from 4 trillion to 7 trillion. And I think that these rates of expenditure cannot be maintained. Number one, in the beginning, everybody wanted to do the right thing and support the economy. More recently, politics has reared its head. And they've been trying for the last month to come up with a new support package, a new rescue package. And the two parties haven't been able to agree, so nothing's been done. I'll give you a micro example. When the package came out at the end of March, I think it was March 26th, they announced that the federal government would give each unemployed person who made up to $100,000 $600 a week. Mm-hmm. Now they get $350 as the average unemployment. The states in America pay the unemployment. So the average unemployment is $350 a week, and the federal government added $600. So the average unemployed worker got $950 a week, which is almost $50,000 a year. And for many people, that's more than they made when they were working. So many people had more money unemployed than they made when they worked. And of course, they were able to spend more, and that supported the economy. So retail sales in the US were quite good in April, for example, and May. But the government doesn't want to do that anymore. And they don't want to give people incentive to not work. Now they want them to have incentive to work. So now they're talking about $300 a month rather than $600. Well, obviously, if several 10 plus million unemployed people get $300 a week less per person, that's a substantial reduction in the liquidity in the economy. And I think that there will be, eventually ramifications.
Perfect. Howard, I'd like also to ask a question. I think you already were very precise in describing the investment process that you go through with these opportunity funds. But just because some of the audience is new to this asset class, if we could go back and perhaps go deeper in terms of what is the step-by-step, without revealing, obviously, the secret sauce of your investment process. Of course, I think you have a team that has been on the road for 20, 30, 50 years. So some of the alpha that you're really generating is return to human capital, experience, knowledge, connectivity. So how do you go about it, both in terms of the connections and sometimes some of these deals, they are unsolicited. Somebody calls and they need you in the capital structure. So how do you go about also doing the analytics of the assessment of those credits?
Well, first of all, in terms of the opportunities, obviously, you know, some people are distressed debt investors, and that's all they do is distressed debt investing. We have the distressed debt funds, but we also are leaders in high yield bonds and in leveraged loans and in real estate debt and in what we call structured credit, which is mortgage-backed securities and asset-backed securities and CDOs and CLOs and so forth, and private lending and mezzanine lending and many forms of lending. So we have contacts all over the credit markets, and we have, I think, hopefully, a superior access to investment opportunities. The other thing that's very important is we have a reputation over the last 32 years of treating people fairly and being good for our word and having integrity and honesty. Now, what that means is this. Let's say you're a troubled company. You have debt maturing in 3 months. You have to borrow $500 million, and you know it's urgent. You need somebody who can commit to it quickly and who you can depend on. Mm-hmm. So they come to us. We have the biggest fund. We have more money available than anybody else, and we have the most experience, so we can make the decision quickly. We have expertise in many industries, and we have people who've been making these decisions for decades, as you say. The other thing is this. So they come to us, we look at it for a few days, we negotiate, we say, okay, we'll do that. You have your $500 million that you need to reach to pay off your debt. Now, what some people do, or may be tempted to do, is they say, okay, now we're going to turn it over to the lawyers and draw up a contract. So the lawyers work on it for 4 weeks or 6 weeks or 8 weeks. And now, when we're getting close to that debt maturity deadline, they come back and they say, you know what? We're not going to do it for 14%. We need 16%. And of course, the borrower has little choice but to say yes, because it's the last minute. We've never done that in 32 years. We call that retrading. We've never retraded a deal. We've never failed to provide the capital that we say we'll provide. And so we have a great reputation as a dependable lender when you have a problem. So I think that's very important.
Yeah, so there's a huge goodwill there, no?
Yeah, I think so. And, you know, we have done 10 to 15 rescues in the last 5 months from April 1st. Each one has been multi-$100 million, ranging from 250 up to 1.2 billion. And everyone has been done on our word and successfully. So the other thing is, you asked about the analytical process. And as you say, I can't summarize the secret sauce, and there is no secret sauce. The secret sauce is the skill of the people and the experience of the people. But we have a process, and I think that your listeners will be interested to learn about it. And back in 88, when we went on the road to describe our first fund, and by the way, our first fund was $96 million, and we thought it was all the money in the world. And now we have many days when we invest much more than that. But we had a $96 million first fund that took us about a year and a half or 2 years to invest. 2 years, I think. And I synthesized our process into 3 questions. And every analyst has to ask 3 questions about every investment. Number 1, by the time we complete the process and the company goes through a reorganization, presuming it goes into bankruptcy and presuming that it is reorganized, and the and it's restructured financially, how much will the company be worth? In other words, there's a pie. How much will the pie be worth? How much would an intelligent, willing buyer pay for it at the end of the restructuring? Number two, how will that pie be cut up among the people who have claims to it? How much money will go to the senior lenders? How much to the junior lenders? Will any money go to the preferred stockholders? What about mortgage holders? Will anything go to the employee pension fund? Will anything go to people who have brought lawsuits? Are there any taxes due to the government? So you have this pie, you think it'll be worth X. How will it be divided up among the various people who have a claim on the pie? Number three, how long will it take? Mm-hmm. Will it take 1 year, 2 years, 3 years, 4 years? So if you can buy a piece of debt at a certain dollar price, and you know how much debt there is, what the company will be worth, what percentage of that value will go to the debt you're buying, and how long it'll take, you can figure out precisely what the rate of return will be. Now, it'll only be that if your assumptions are correct. So you have to be skillful in making those assumptions. But if you can answer the three questions, and we have a lot of experience doing that, you can figure out the return on each potential investment. And that's essentially how we do it, Paulo.
Fantastic. Mariana, any questions?
Yes. When thinking about, you mentioned the goodwill in investing in behalf, when talking about potential rescue financing. But you often highlight the importance of leadership when in the financial restructuring of a company. Can you tell us about the most important governance pillars that you look for a company to succeed in the restructuring process?
Well, I think that it's very important to have influence, and the principal question is, how will that pie be cut up? And since we're the largest fund, we're often the largest holder of debt, and that gives us influence on how the pie is cut up. So using our experience and using our skill and working with the management and the other creditors with whom we basically have the goodwill that you described, we're able to influence the restructuring, and historically that's been very valuable.
Change a little bit, having your expertise in terms, you're always right so clearly in terms of behavioral finance and cognitive biases, right? I mean, I think people missed the 2230 on the S&P, and now they're trying to chase the ambulance at 3400. I mean, how do you see valuations in general across asset classes, let's say equities, because there are many animals. I mean, some have PEs that are not really compatible with the dividend yield, but others are still well below and have not recovered. Yeah. And certainly within your universe of a high yield, I mean, the spread compression is gigantic. I mean, so what do you think in terms of valuations today?
Well, I think that the winners are fully valued. The losers, as usual, the companies whose business models have been thrown into question, like a cruise ship or an airline or something like that, there may be excessive confidence with regard to the tech winners and insufficient confidence with regard to the companies whose models are troubled. The other thing is, of course, that the Fed cutting interest rates to zero, people are eager to invest in the companies that they have confidence in, and that would contribute to the successful companies being fully or overvalued. They don't have that level of confidence in the more troubled companies, so those are not highly valued. And at a time when the prevailing interest rate is zero, and Treasury bonds pay 1% plus or minus, and high yield bonds pay 5%, we're still able to secure attractive double-digit returns on our private rescues. So, we never invest in market darlings. By definition, we don't invest in the companies that everybody thinks are doing great and can't miss. The companies we invest in, by definition, since they're financially stressed, are under some cloud. Historically, Oaktree has been able to distinguish between the ones that are under a cloud and deserve to be, and the ones that are under a cloud but are really better than that. And as long as we can do that, I think we'll be successful in making money for our investors.
Howard, you mentioned disruption, and obviously before we were talking about disruption more in the context of technology. But what are some of the measures that you're taking to make sure that you don't invest in companies that may have been good at a time pre-COVID, that seems like it was a lifetime ago, but these companies may no longer be viable after COVID?
Well, look, in investing, there's no magic method. There's no machine that you can turn to get the right answers to these questions. All of the important questions in investing are a matter of judgment. Mariana, we have to make a judgment about whether the companies we're investing in will have a successful business model or whether their business model will be disrupted. We try to make that judgment. Historically, we've been able to make that judgment. Nowadays, in a time of rapid technological change, it's more important than ever. I hope and believe that we'll continue to be able to do that. I mentioned that we don't invest in technology. We don't invest in fashion or in fads or in styles or in intellectual property or things that where there's no tangible assets and your success versus your failure is a matter of days. So we don't invest in the most fragile of situations, but we still have to make judgments. I'll give you a great example. And my book, Mastering the Market Cycle, which I don't know, maybe you'll have to read in school one of these days, talks about the danger of disruption. And industries, companies are subject to cyclical ups and downs. And if you go back 20 to 25 years, the newspaper industry was considered one of the most secure industries, and the companies were considered defensive. That is to say, they couldn't have a problem. They could not be attacked. And the stocks were considered very safe. And people invested in newspapers for great safety. If you had a newspaper in your town, number one, the movies had to put their time schedule in your newspaper. And number two, the local car dealer had to advertise in your newspaper. And they couldn't advertise in the newspaper in the next town because their customers were in your town. So your local newspaper had something of a monopoly. And that's why these companies were described as having a great moat. And they could not be subject to competition. Well, guess what? The internet has changed all that. And the newspaper industry, which was considered so secure, is now struggling for survival. And it's only you look at the New York Times, which is the greatest newspaper in the world, or historically has been, it's only the controversy over Donald Trump that's been keeping it alive. So the point is, these things are subject to change, and the successful investors are the people who anticipate the change and not the people who are blindsided by it. And we understand the need for that. And again, I hope that we will continue to have the skill and the foresight to be able to anticipate and avoid disruption.
Paulo, you're on mute.
Sorry, just a very quick question. I think we're close to the hour here, but just thinking about the portfolio in general, just trying to think as factors that would affect the performance of the portfolio, how in general they would respond to changes in the expected growth, interest rates, yield curve, and inflation. So how defensive or not is a portfolio of distressed the way that you are planning to build responsive to those variables?
Yes. Well, our companies, I think, just to sum up, there's no easy answer because all companies are different. The portfolios are different from time to time because the industries which are troubled are different from time to time. And it's hard to tell you today what we're going to invest in a year from now. But I think the answer is that we invest for high rates of return, which are contractual rates of return. When we make an investment in a rescue, for example, and they promise to pay us 15% interest, that 15% is a certainty unless they can pay us. And if they can't pay us, we get the company and the assets. So that's the reason why 90% of our outcomes have been favorable historically. And I think that when you invest at a high rate of interest or a low dollar price on debt, it gives you resistance to surprises. It gives you what we call margin of safety. That is the ability to be okay even if things go against you. And it gives you the possibility of high returns. And I think that's the reason for our record over the 32 years. And I hope it will continue to be true.
Thank you, Howard. I think we're close to closing. I don't know if you'd like to make some closing remarks, Howard, in terms of the fund and of this opportunity.
No, I think, look, we've given good returns with safety in the past. We've treated people well. People have gotten what they expect. Historically, we've sized our funds right. Our biggest funds have been our best performers in each cycle. Obviously, look, as I mentioned, I can't anticipate what we'll be doing a year from now. I can't tell you what the returns on our fund will be or even how many opportunities we have. But I do believe that whatever the investments are that emerge over the next year, I think that the distressed debt universe will see the best ones, and hopefully Oaktree will be able to select the best of the best.
Very good. Mariana, I would like to make the closing remarks.
Sure. Well, thank you so much, Howard. It's been an absolute blast to have you with us here today. I'll switch back to Portuguese. Queria agradecer a todos pela presença de hoje. Espero que vocês tenham gostado da conversa. Nós, com certeza, adoramos. E para mais informações sobre essa e outras oportunidades de investimento para clientes XP, por favor, entre em contato com seu assessor. Boa tarde a todos e até a próxima.
Howard, thank you so much and stay well.
Obrigado.
Nada.
Obrigada, Howard.
Okay, bye-bye.
Bye.